My name is TradeX, and the chances are you're watching this video because you are sick to death of churning account and losing money in the market. If that is you, stay to the end because this could be the one episode which changes your trajectory in trading. Now let's set the scene for a minute. You've gone and learned a model on Twitter and potentially even gone into that trader's mentorship who you aspire to be like. You've learned that model inside and out. Yet when it comes to deploying it in the market, sometimes you are consistent, but sometimes you take that inevitable losing trade, and that then leads to tilt, which enables you to then go and blow your account. What we have to understand in trading is this. The only constant is risk management. Everything else is a variable. Whether it's the model or whether it's the way that price is delivered, everything is a variable bar risk management. So the difference between that trader who's buying his Lamborghini or his family house is his ability to control risk. And what you need to understand very, very quickly is how to do that. And in this episode, I'm going to show you how to set your dollar risk per trade depending on your account size. And your account size, especially if you're trading prop firm accounts, is your max drawdown. I'm also going to show you exactly how many contracts you can take depending on the dollar amount you risk per trade. And I'm also going to show you how that is relevant to risk to reward. So for me personally, my risk to reward is 3-to-1. And it's for a very specific reason, because I can take 7 trades in a row wrong, yet I can take 3 trades, the last 3 trades of those 10. And as long as they are hitting my TP with my 3-to-1R, I am net green overall. Once you finally understand that little mental shift, you start going away from the whole tilt episodes and focusing on such a small fraction of time, and you think long term. If you're looking to make $3-5 million out of trading, it doesn't come in one single day. It comes over 1,000 different trades of winners and losers. You are going to take losing trades. Let me tell you, you are going to take losing trades. I take losing trades. It's your ability to control that risk. So stop worrying about trying to find the next Hail Mary or the next Holy Grail trading model. It doesn't exist. The Holy Grail is risk management. So watch this video to the end and you will start trading with an elite risk management plan. Okay, enjoy the video. If you like it, smash a like, hit the subscribe, all that fun stuff. Drop comments in below if you have any points to add, and I'll see you very, very soon. Abosh.
Okay, let's jump straight into it and start with standardization using my cheat sheet here, which I've created. And this cheat sheet gives you all of the standardization for each contracts within the index futures. So you can see here, you've got the S&P, the mini and the micro. You've got the Dow Jones mini and micro. You've got the NASDAQ mini and micro. That's the large contract. And you've also got the Russell 2000. What I'm going to do today is focus on the NASDAQ, as that's predominantly what I trade. And it's also what a lot of the traders who I teach trade. If you want to grab this cheat sheet and any of the documents that I'm going to show you today, feel free to do so. They'll be in the description below. But standardization is going to show you how price moves in dollars and cents depending on the tick size change of the contract. So for every contract that you take, every tick change is going to have a relevant change in dollars and cents. If we look at the NASDAQ, the E-mini, which is the largest contract for the NASDAQ, for every contract that you take, every tick change, which is 0.25 incremental change, the contract goes up and down $5. So 1.4 tick changes is going to be $20, right? So for every 1 point change in the mini contract is $20. Now for the micro, that's 1/10 the size. So that is for every tick change. So for every 0.25 change, it's going to go up 50 cents. For every 1 point, it's going to be $2. Depending on your account size, whether you can trade the mini or the micro. Now, what I say to a lot of traders, especially if they're trading with a $50,000 evaluation account or funded account, is you don't need to be trading the E-mini. Trade the micro and just take more contracts. So this leads us on to the next section, which is on my MNQ cheat sheet. As I've alluded to, this is what you should be trading with a $50,000 account. It's based on a $2,000 max drawdown. Now, if your max drawdown is slightly different with your prop firm account, you can change it. Utilize my risk management and position size calculator, which I'll show you very, very soon. You can download that and start playing around with it to dial this in for you specifically. But for a $2,000 max drawdown, which is top steps, $50,000 evaluation account, this is what it's dialed in for. And it's a 3-to-1 risk to reward model. This is super important because too often do I see it blanket 10 contracts and then you're constantly moving your stop loss around. There's no way to control your risk. As I mentioned before, risk is the most important element to manage in your trading. If you can get a firm grasp on this, you're taking your trading to a whole nother level. This top row in each individual box shows you the amount of dollar risk you can take depending on a percentage of your max drawdown of your account. If we looked at table 1, if you had a $200 risk and you fixed it, which would be a 10% of your max drawdown, you would have to take 10 consecutive wrong trades in a row to lose your account. Just think about that for a minute. 10 in a row. If you're taking 10 consecutive wrong trades, you're probably needing to go back to the drawing board. If you were using a $300 risk and you fixed your risk at $300, which would be 15% of your entire drawdown, then you would be 7 trades wrong to lose your account. And then finally, in table, $400 risk would be a 20% risk on your drawdown, and 5 consecutive trades would lose account. Bear in mind, this is very different to total account size. Okay, so a total account size would be 50K. However, you're not trading with a 50K account, because if you lose $2,000, you lose the account. The reality is you only trade with a $2,000 account. So your risk has to be married to your max drawdown, not your prop firm evaluation account size. This is the most important element, understanding how to contract size. With a $200 risk, if I took a 6-point stop loss trade, so a trade with a 6-point stop loss, I would be needing 18-point TP. However, I could take 15 contracts. And what that will do will give me a $200 risk. If I lose that trade, I will lose $200. However, if I win that trade, I'll make $600. So it's a 3-to-1 R, but I would make 600 or lose 200. Now, the very same trader or a different trader, so trader B, could take the exact same entry, but with a different risk criteria and get exactly the same profit. However, they have to change their stop loss and their TP to achieve that. The exact same entry, the exact same model, but with a different stop loss size, a 30-point stop loss with 2 MNQ contracts with a 90 TP would still be a $200 risk with 600 TP. Another trade in the exact same day, just in a different setup, that had a 15-point stop loss and a 45-point TP, I could take 7 contracts. Again, $200 risk, 600 profit. This is really important because depending on the trade setup that you are looking to take, you need to fine tune the stop loss size and your TP size inside of a minimum 3-to-1 R. So if you don't see a trade that delivers a 3-to-1 R inside of your risk criteria, you can't take that trade. It's that simple. It filters out your trades. So for example, let's say you're trading a breaker block, but you saw that you were inside of a unicorn and you didn't want to trade the very high of the breaker block. You wanted to open up your stop a little bit to allow it to fill the BISI which created the unicorn. Well, you might have a 15-point stop, which means you can only take 7 contracts, but your TP is 45, which would allow you to take that trade. However, if I was trading the actual turtle suit, so before the breaker block actually took place, I might have a much cleaner entry and be able to take a risk with 6-point stop, which means I could now nail on 15 contracts, but go for 18 and hold runners beyond that. My average across a year is a 5-to-1 R, and that's how I do it. The same is true for 300. You have to decide where you want to sit and fix your dollar risk amount, but then you tailor your contracts to that risk depending on the trade setup. This document here is completely available to download. Feel free to grab it. It's in the description below. But now let's jump into the risk management and position size calculator so you can start seeing this for yourself. This is freely available for you to download, by the way. Up here, this is where you can change your drawdown size. Up here on a top step 50K, it's $2,000. You need to determine here what level of risk you are prepared to take every single trade. If you're looking for $200 from the previous table that I've shown you, that is a 10% risk. 10 trades wrong in a row, you lose your account. Now, the next thing you want to consider is your risk to reward. I personally go for a minimum 3-to-1 R. And the reason for that, it means that I only need to be right 30% of the time. My consistency and average across the year is 70%. But I only need to be right 30% of the time, which gives me confidence in my trading to not worry about taking a losing trade. It really doesn't matter to me because I know that I can take 3 trades out of 10 and I'm still net green. But once you've understood that, you go back into page 1, so sheet 1, and up here is where your account size, the drawdown size, and up here is where you'll put your percentage risk, 10% with $200 risk. What that will do is show you exactly how many contracts that you can take depending on that dollar risk amount. If, for example, you saw a trade with a 10-point stop. That would allow you to take 10 contracts for $200 risk. Just remember your 3-to-1. So if you're going to take 10 contracts, you have to at least go for 3-to-1, 30-point TP. If I saw a trade, but it had a 20-point stop size, I can only take 5 contracts, but again, I would have to go for a 60-point TP. So unless the trade allowed me to take 60 points, I couldn't take that trade. Finally, if I saw an absolute sniper entry with a 3-point stop, well, I could take 33 contracts and I would only need to go for a 9-point TP. I personally don't sniper trade like that. I'm more of a range trader. So for me, I sit anywhere between 8 and 12. That's generally where I'm at. What you can then do is flip this to NQ, and this will do the exact same thing. Same $200 risk, but now you can see the amount of contracts you can take. If you've got stop size with 10 points, you can only take 1 contract, right? So how many times do you see it where a trader has taken a trade with a 20-point stop and they've gone and lumped on 3 contracts? It's just mental. Like, your risk gone completely out the window. So what this shows you, if you have a trade which has a stop size which is greater than 10, and then with the volatility in the market at the moment, that's 9 times out of 10, and you're trading with a $200 risk, you physically cannot trade the mini contract. You have to take the micros, right? It's physically impossible. It's less than 1. So this is where it becomes really, really important, because you can now drop down to the micro, right? So if you saw a trade on NQ, which is the contract for the NASDAQ, and you were like, well, I actually see a trade here, but it's got a 15-point stop. Why in God's name would you trade that with NQ when you know that you physically can't do it within your risk parameters? What you could do, flip to MNQ, and that 15-point would allow you to take 7 contracts if you rounded it up, and take the exact same trade on micros, but keep to your risk level. Okay, so in conclusion, guys, you want to find your dollar risk and marry it to a percentage of your max drawdown of your account. You then want to understand how many contracts you can take dependent on your stop loss size per trade. You then want to understand your minimum risk to reward, and you stick to that religiously. If you can do that, and you do that consistently, and you deploy your model, which you have learned multiple times over a long period of time, you will find consistency that you are looking for. If you want to learn any of my models, you want to trade the way that I trade, utilizing X levels and my advanced market structure, plus the 11 models which I've developed and everything I teach about context and bias, you can do. Simply jump into Red Pill University. If you found this valuable, guys, consider smashing the like and subscribe. And don't forget, you can grab any of these documents. Just head to the description below. Until next time, guys, trade safe, trade smart, smash the like and subscribe, and I'll see you on the next episode. Abosh.